CPI out tomorrow. How are traders positioned? Welcome to Real Vision Daily Briefing. It's Monday, February 13, 2023. I'm Ash Bennington, joined today by Dave Floyd, founder of Aspen Trading Group, and a little later in the show, Weston Nakamura. We got a great show ahead of us. Dave, welcome.
Hey, Ash. Thanks for having me back.
It's a pleasure to have you back. Dave, we said it at the top of the show, CPI out tomorrow. What are your thoughts? How are you positioning yourself ahead of tomorrow's number?
I'll answer your second question first. I'm not positioning ahead of it. For me, it's too much of a binary outcome. I don't see an upside. If you catch it one way or the other, I think it's pretty equal to the upside, equal to the downside in terms of the market's reaction. So for me, that's not really a bet that I want to take.
Dave, explain a little bit what you mean by binary outcome.
Well, the way I look at it is, given that the CPI is such a focal point right now, if it misses big or if it comes in really, light, the market's going to scream up or it's going to scream down. So to me, if I go in positioned long or short, I don't view that as, if I'm right, I'm going to make 3x, but if I'm wrong, I'm only going to lose 1x. It's going to be 3x either way. And to me, that's just not worth it. I don't want to set myself up for a situation where I'm positioned to make 3x or 2x on my capital, but I'm also going to lose that amount too if I'm wrong. So to me, I might miss out on the big initial move. That's okay. With my capital, and I've got clients' capital, that to me is just not the right way to do it, unless of course you're going in with some hedging strategies and whatnot, and that's just not part of my overall game plan on a day-to-day basis. I'm purely in for the position and not hedged accordingly.
So you're looking for asymmetric returns. When you don't see them, you don't play.
Bingo. That's exactly right. That's exactly right. And you know what? I guarantee there'll be some trades after the fact. Yeah, the market could go on a one-way move up or down after the fact, but there'll be some pullbacks along the way, and then that's where I'll get in there and hopefully identify those asymmetric returns that you're mentioning.
Well, let's take a little bit of a look here into what's happening with CPI. Brian, Peter, if we could pull up that chart and just take a look at where CPI has been, give us a sense of what this looks like. Obviously, we've seen some moderation in that number off a high of, I believe, 9.5%. So obviously, this is something that's been coming down a bit here in recent months on recent prints. I want to give you a little bit of context here. This is from the Wall Street Journal out today, just to give you a sense of what the expectations are. Quote, economists expect year-on-year inflation was 6.2% in January. That would mark the 7th straight month of easing. In December, inflation was at 6.5%. Core inflation, which strips out the volatile food and energy categories, so ex-food and energy, is seen rising 5.4% after a 5.7% rise in January, close quote. Dave, that gives a little bit of context to it. What does that mean in terms of what your positioning is in markets? For example, I know we were talking a little bit earlier before the show about your positioning on the S&P. Give us a little bit of a sense of what this means for markets more broadly, contextually.
Well, again, this is kind of getting into more of the fundamental stuff, and that's not necessarily in my wheelhouse. However, those are things that have to go through your head in terms of an understanding of what the market's looking at and what they're expecting. And as I kind of read into what was said right there and read into other reports that I've gone through, it's really more of a question is, where's the floor in this inflation coming off the highs, which is great. But the question is it going to get sticky up here? Or is it, going to magically go to 2% like where the Fed wants it to? That seems to me obviously a bit unrealistic. So I think the way people are going to be looking at this report tomorrow is, are we still staying with sticky inflation? Yes, well off the highs, but certainly not, falling in a rapid manner that's going to allow the Fed to change their stance on monetary policy. And we're still dealing with a market whose collective psychology is, we need low interest rates. We need quote unquote free money. We're still caught up in that decade-old mindset. So everybody's latching on to, when can we get the free money again? And I'm using that just as a general catchphrase.
Right.
And until the CPI or until the market collectively agrees on where that floor in inflation comes in, that's the debate we're going to be going back and forth on, and that's going to create a lot of volatility on a week-to-week, day-to-day basis.
Let me give a little bit of context here, again, not to get too far into the fundamentals, but what's happening here. So the U.S. economy added 517,000 jobs in January. That was a blowout number. The forecast was it's 2.5x the forecast or thereabouts, 2.3x. Unemployment rate now sits at 3.4%. That's the lowest in more than 50 years. By the way, let me just correct myself here. All items CPI peaked in June at 9.1%, not 9.5%, but it still gives you first order magnitude. It's almost, I guess, a little bit silly because we don't really know how accurate these numbers are in terms of the real sense. Where this is just a single gauge of inflation, obviously, and it's hard to measure this stuff precisely. And sometimes we think we get a little too caught up in was it 9.1 or 9.5? So, Dave, do you have any thoughts in terms of the positioning when you look at that broader macroeconomic framework? I know you trade essentially on technical factors, but do you think about that when you see a number that comes out 2.5x or thereabouts higher, like the jobs number did, the NFP number did? When you look at a number like that, does that have an influence on the way that you think about what's happening?
Well, for sure. I mean, and obviously the reaction that the market has to it adds to that. And actually, for me, that adds to clarity. It's like, okay, the market saw the number, it's doing this. Who am I to argue? I'll go in line with that. It is puzzling, though, given that everybody's calling for a recession and the fact that we've had a rapid rise in interest rates over the last year. It is puzzling to see the jobs still so strong. I mean, that's a good thing. Don't get me wrong. But I think the one thing that I'm always trying to keep in the back of my mind is, lag effects, other things that could signal that maybe we are slowing down, credit spreads, watching the volatility index. Those are the measures that usually start to give an indication as to what we're seeing right now. While it may be good, we're looking at a delayed sense of where we are in the economic cycle. And that's about as far as I take it in terms of trying to outguess anything, because I think that's a really hard game to outguess what's happening on a macro level, given the magnitude of the inputs that go into it and the kind of the mental gymnastics you need to do to say, well, if this is that, then this will become that. And then that becomes a really complicated mosaic to sort out.
Dave, let me just ask you one more question on this. When you say behind where we should be in the cycle, what does that mean?
Well, what I mean by that is, if we're looking at that jobs data, that was from 4 weeks ago. Here we are a month later, we're looking at data that took place 4 weeks ago. We don't know what the knock-on effect eventually is going to be. If that was, let's say, a growth of jobs in like super high-paying jobs, well, that knock-on effect is going to be relatively robust because probably people are going to be spending a little bit more. Conversely, if it was a low jobs number, it's like, ooh, what does that mean 4 weeks from now? Now those people have been laid off, they've cut back spending, and you get the ripple effect that way. So that's all I mean, is that we're looking at a snapshot back in time. It's reported on 4 weeks forward, and you have to at least keep that in mind in terms of how that data is presented.
I also want to bring Weston Nakamura back into this conversation. Obviously, lots going on today, lots happening in the news cycle in terms of Japan, BOJ. Hey, Weston, welcome back.
Thank you. Hey, gentlemen. Thanks for letting me interrupt. I was enjoying what you guys were saying. I was taking notes.
Well, this is great because both of you guys are looking at USD JPY. Weston, I know you're looking at what's happening in Japan right now in terms of BOJ. Obviously, this is a huge story. It's one of those moments where it's broken out of the Japanese news cycle and into the broader financial news cycle. Give us the 50,000-foot overview. What's going on? What do you see happening?
Sure. Yeah. So the biggest sort of, macro story that's been going on for the last since Friday, really, or actually since a week ago, really Monday, is this intense focus on who the next Bank of Japan governor will be to succeed current Governor Haruhiko Kuroda, the most dovish central banker on steroids maybe ever. And so on Friday of last week, it was announced by the Nikkei, the media publication, that this guy Kazuo Ueda has been named the next BOJ governor to succeed current Governor Kuroda. Or so it would seem if you read and watch any of the financial media and all the published analysis since Friday. But let me be absolutely clear. Despite the immense chatter of this next BOJ governor and his policies that will be implemented and the direction of BOJ policy, as of this current moment, there is no Bank of Japan official nomination. This was started by a Nikkei article released on Friday after Japan hours. The media just ran with this. And even if it becomes a fact, it is currently not a fact. Okay, so the Prime Minister of Japan nominates Bank of Japan governors, not the media. So I'm still sticking with my super contrarian call somehow, super contrarian, that although it may very well be Ueda who's chosen, there's still a far higher possibility of a completely different nominee named in a few hours from now at 11 a.m. Japan time than what the broad consensus already has accepted. And by far higher probability, I mean even a 1% chance that it's someone else makes it an infinitely greater probability than the 100% certainty done deal that the broad consensus is acting upon. So basically, the timeline from just like a week ago is basically goes as follows. A week ago on Monday, before Japan AM Open, current Deputy Governor Amamiya was leaked as the name for the job by this same publication, by Nikkei. The same Nikkei who will later go on this week to say that it was this Ueda guy on Friday. On Friday, the Nikkei says out of nowhere, is this like no-name guy. But the real takeaway from that, what I call press test, right, where essentially the government or Bank of Japan is basically working in tandem with the Nikkei, throwing things out there to see what market reaction is so that they don't have to, so that if markets react in a volatile manner, they could always just take it back and say that's fake news, it's nonsense, whatever. But they can't do it themselves because then it's official, right? So that they're testing all these names and all that. And what the takeaway from the Friday thing is not the naming of this guy, this really no-name guy, right? It's what it was testing of the headline. The real headline test was, what if it weren't this assumed lifelong BOJ architect Amamiya who's been there? That was the real headline test. But they couldn't just like throw that out there and leave that there, because the narrative would then become nobody wants the job, and that would be horrendous. So the Ueda was likely a kind of a filler name, and then this filler name might actually become the real nominee because how markets didn't like jolt into extreme volatility. Either way, we don't know for sure yet who it is, and it's kind of irresponsible, if not outright stupid, for all this very widespread acceptance of this analysis of this guy before the actual announcement to take place. And it actually shows the state of the market participants and commentators to be headline tourists, which is actually great because it could set up for like badly mispriced market trading opportunities in sort of the future. So
well, let's talk a little bit about that. And we're going to pull Dave in talking about the yen in just 1 second. But let's talk a little bit about that in terms of what the expectations are, or what the rumor mongering, I guess, might be the best way to say it, is right now in Japan and across the globe. I think the FT had an article out today, an opinion piece, saying that the expectation with Mr. Ueda is that he is going to continue ultra-accommodative monetary policy. Is that the general framework that markets in Japan and analysts in Japan are applying to this news flow?
I just first want to remind everyone that the FT that you just cited is owned by Nikkei. Remember that. Now, here's just like just a couple key points, right? First of all, anyone, okay, and I mean any single individual on planet Earth for eligibility to be nominated as the next Bank of Japan governor will be a hawk relative to current BOJ Governor Kuroda. Like, if you think Kuroda and the BOJ, turned hawkish at the December policy meeting in which they kind of shock-lifted the 10-year JGB yield curve control trading ban, and if you ignored what he had explicitly said at the time, that this is not a departure from easing, if you ignored it or doubted all that, just take a look at what the BOJ has done since this so-called end of the BOJ easing regime that day in December. So immediately following that day in December of that meeting, okay, and the remaining days of the year of 2022, BOJ is not only conducting these fixed-rate, unlimited buying operations on the 10-year JGB, as they had been since the implementation of yield curve control in September 2016, but following the December 22 meeting, BOJ began conducting fixed-rate, unlimited buying operations on the 2-year and 5-year JGBs for the first time ever. Okay, and then January of last month, January of 2023, the Bank of Japan bought a record 23 trillion yen in JGBs for the month. Okay, so for simplicity's sake, let's just use exchange rate of dollar yen 130. Okay, so that's basically what they did was they bought $180 billion in JGBs for the month of January of 2023. And for context, that amount of QE, that the amount of QE that the U.S. Fed was doing during the doomsdays of March 2020 was 120 billion a month, as the global economy was imploding. The Bank of Japan did 50% more QE last month than the Fed did at its QE peak, and they did it just last month, with half of which was done, by the way, 2 trading days, and they did so into rising inflation in Japan. Okay, so forget the relative sizes of each economy, the U.S. being 4x larger. On an absolute level, the Bank of Japan fire hose the punch bowl. So that BOJ policy meeting shock rate hike and this so-called end of BOJ policy easing that was touted at the time and still touted today, let's rethink that one. Just as Governor Kuroda has explicitly repeated ad nauseum, since the Bank of Japan December shock policy meeting, they've not only not been not tightening, they've eased to levels never before seen or measured, even by Fed standards. Okay,
all right, talking about things that are being measured, Weston, I want to switch here a little bit from the context of the framework theoretical to the actual price action that we're seeing here. I want to take a look at some charts and bring in Dave Floyd, of course, who is positioning on this and thinking about it. I want to bring in first the 5-year chart. This is USG JPY. This is dollar yen. And you see this is the big picture chart. You see that very large spike up in 2022, peaking, I guess, in around October 7th at about 145 or thereabouts. Then we go onto the 1-year chart. And if you take a look at this chart, what you see is kind of this almost a curious zoom in on that little bump in the middle, that rise in the middle, where you see that kind of mountain pattern. And finally, I want to switch to the 30-day chart for a little bit more tactical view of what's happening here in USD JPY. This gives you a sense of where we've gone over the last 30 days, and it's been kind of up at a 45-degree angle from around, call it 128 to around 132 on this chart. Dave, you heard Weston talking about what's going on there, how he's thinking about this from an analytics standpoint in terms of what's next for the Bank of Japan. Give us a little bit of a sense that you have when you're looking at this on a technical basis and as a trader.
Yeah, for me, dollar yen, for kind of to be full disclosure, it's one of the currency pairs that I definitely trade. It's probably the one that I have the most difficulty with. I've always found it to be challenging over the years. So I want to be straight up about that. But nonetheless, I've done okay with it. But something like the euro or something, I usually have a better read on, and that's a common thing I share with a lot of other of my colleagues that I've spoken to over the years. So dollar yen's a real tricky one to trade. That being said,
why is that, Dave? What's the driver of that?
That's a good question. I've heard so many different things over the years. I had a colleague of mine years ago, and I think there's actually some truth to this. The way a currency trades seems to be indicative of their culture, kind of how their culture is. And I don't know I know what he meant by that, but it kind of makes sense, because if you look at the majority of trade participation that takes in a current, or the majority of trade participation in a currency, at least in the FX market, being redundant there, in the FX market, a lot of that order flow is coming from the home country. Therefore, people have a different way of interpreting things. They have different risk tolerances. Again, this is just one person's view that I heard, and I was like, well, that's kind of interesting, because you look at the British pound. Most people associate the British pound or the Britain with something austere and very regal, but British society, at least maybe at a blue collar level, it's kind of rough and tumble, and the British pound is kind of a rough and tumble currency. It's quite volatile at times. Japanese yen, I've noticed over the years, it tends to be very methodical, very levels driven, and also at the same time, when it breaks a level, it can react really, really quickly. So very different characteristic than, let's say, the way the euro trades. So what's the reasoning? I couldn't tell you, although I suspect all of this policy easing and whatnot has a huge impact on the way dollar yen trades. It's a little inconsistent with the level of QE that Weston just mentioned, at least in terms of the last 30 or last 2 months, actually, because the yen has actually strengthened. But again, correlations are always in flux. But to go back to your original question, how am I seeing dollar yen right now? I'm pretty bullish on it, to be quite honest. I mean, we've had a good move off of the November highs, or I think that was actually the October highs. October 21st of 2022. We've sold off into January 15th, and we started to squeak a little bit higher. And again, for me, since I'm a levels trader, I don't know if you guys can show my screen here, but I've got us above some pretty key levels here. Those levels being 131.32 and 131.80. So that to me suggests that the market wants to move above critical price levels where a lot of price action has taken place and a lot of volume over a period of time. And that to me is a better representation of where the market wants to go, because it's being driven by where positioning is, as opposed to maybe some other thing that people are looking at, because ultimately at the end of the day, people react on price action.
Yeah, exactly. Dave, let me ask you this. You mentioned Weston's points earlier. You were listening in, obviously, to what he said. Any questions for Weston?
I don't have any questions. I'm really intrigued by the way he digests all this information. It's a different way of viewing the market, and one that's very valuable. So I don't have any questions for him, because everything he came back with made a lot of sense. I think it highlighted what the market's perception of the Bank of Japan's future position is versus what in reality what Weston is seeing it as right now. He's saying it doesn't matter who's elected as the next BOJ governor. No, they could never be as dovish as the current governor. And I thought that was a fantastic point. All the more reason that you might expect maybe dollar yen to go lower in the days and weeks and months ahead if you're going to get somebody in there who's going to be somewhat tighter. But again, that hasn't developed, and I'll wait for that to come in due time as to where dollar yen goes and make a decision accordingly.
So let me jump in. It looks like we've got some questions here from our viewers I wanted to get out. So this one comes to us from Roger Bose from the Real Vision website. Dave, would you take a risk on BOIL at this price level?
I'm sorry, was it on oil?
He says BOIL, B-O-I-L. I haven't the faintest idea what that means.
Ooh, yeah, I appreciate the question, Roger, but I don't know if you're seeing my screen right now, but the tabs across my screen are pretty much the markets that I follow closely. Doesn't mean I can't pull up BOIL. Like, I'm happy to bring that up right now, but I'm going to be giving you a very cursory and maybe not the type of information you might want. But hey, let's pull it up.
Ash, can I just show that chart just to lead on what Dave was saying about, like, because those levels on dollar yen, I have that chart exactly, like, from a different angle, but the exact same levels.
Yeah, if we can share that. By the way, I think it's talking about the ProShares Ultra Bloomberg Natural Gas Index. Is that what you're pulling up, Dave?
Yeah, I believe that's what it is. The way my chart is set up, it doesn't show what the actual name of the symbol is, or the name corresponding to the symbol. Technically speaking, I mean, this is a train wreck, at least if you're bullish. And I'm speculating here, Roger, but if you're asking from the standpoint of, should I be a buyer because it's quote unquote so cheap? No. The market is speaking volumes to us based on this chart alone. While it may seem counterintuitive, our human brains want to twist things around. If anything, you should just stick with the trend and short it. I'm not saying to do that. And I'm speculating that you're asking from the standpoint that you're considering going long, but that to me that's a really hard game to play. That's when you start getting into that, you get into the really skewed returns, you get into that negative convexity because you're hoping to make a couple bucks and it just keeps going down further. And I would avoid that. I don't see any reason to want to own this. Would I own it above $9.15? Maybe. That would be the only way I would consider that. It's a technical level that are drawn on my charts that are all based on volume, price, and time. So it's not a subjective measure of the market. It's an objective measure of where participants are kind of battling it out. And when you get moves above or below those levels, the logic is you get an acceleration above or below those levels, and that tells you where we're going. So hopefully that helps, Roger.
Let's see if we can go to Weston's chart. Weston, the chart you were just mentioning. Jump in.
Yeah. So Brian, that's the third chart. So this is so Dave, you mentioned late October as the top in U.S. Treasury yields as well as dollar yen, and then you also mentioned mid-January as the subsequent bottom in those respectively. Those two are, and I could give you the exact, like, down to the second time of like why and where that turned around. The reason that happened, that top tick in October, that was October 21st, is a Friday, October 21st of 2022 at like around 10:30 a.m. Eastern. That was when the Japanese officials did their second round of unilateral yen intervention. They blasted dollar yen down 5 handles in like, I don't know, like half an hour or whatever it was. That triggered an enormous record-sized short squeeze on the very crowded short yen futures position that then led into a whole bunch of catalysts to close out that short yen position. Things like, slowing down of US CPI, a slightly less hawkish Fed, the Bank of Japan getting perceived as getting hawkish on the other side of it, and so on and so forth. And then the January Bank of Japan meeting was the bottom tick in USD JPY as well as 10-year US Treasury yields. So strangely, I mean, look, these markets, obviously the foreign exchange markets are international markets, but the U.S. Treasury market is not a U.S. like market. It is a global asset class. It's a risk-free rate globally, and so you have global market participants, the largest of which, foreign-wise, are Japanese, and so you're going to get like these catalysts that are happening because of Japanese like policy activity that is actually causing these major reversals in these assets. So it's something to certainly keep an eye on. More, I mean, like you get the U.S. CPI numbers and stuff like that. Yeah, you're gonna get that tomorrow, but like the actual big turns, they happen on more so on BOJ and Japan related policy because that's far more sort of uncertain. And then so in terms of like kind of like a near term, immediate term timeline, when we're looking into going into CPI over the next 24 hours, right? This is what we have. We have the Bank of Japan like official nominee that comes out at 11 a.m. Japan time. You also have Japan GDP. Who cares? Nobody cares about that. And then you also have
is that tonight? Is that tonight Eastern time?
Yeah, right. In a few hours from now, right? Whatever and then after that, you also have like a 5-year fund supply operation. Basically, that's the Bank of Japan attempting to keep a lid on 5-year JGB yields. You have an operation set for that, like scheduled for that, and then you have CPI in the AM for the U.S. Now, those three things. Those like 3 catalysts all kind of blended together. What that means is that there is no single like isolated catalyst that you can attribute a market move to. So in other words, if you get whoever the Bank of Japan nominee is or whatever it is, that price action that you see, that's not a reaction, for that, because there's going to be a lot of sideline capital waiting for those other 2 catalysts to occur. And then once you get like the US CPI print, if you see a massive move in whatever direction in any asset class, that could also be pent up flows that now digested we got the BOJ nominee, we got that name, now we're waiting for this, now we're acting in aggregate and all of that, right? So don't like just look at each of those in isolation and say like, oh, the market has interpreted this CPI print as whatever implication for the Fed or whatever it is. No, there's a whole bunch of things that are going to be all wrapped together, and it's going to be basically impossible to discern which is which for that. So it's something
fascinating take, interesting insight, Weston, about the way traders think about markets and how they process data. We have time for one more question here. This one comes to us from Ralph Humphrey. It's a question for Dave. Dave, could you give us a brief short-term outlook for the currencies you follow? I'm mindful that we may be a little bit short on time, so maybe just the highest conviction one that you have right now in terms of FX.
Yeah, right now for me, I'm looking at the euro, which is probably the one that I trade the most. We've been bouncing off of a pretty key support level here at 106.60. I'm bullish on the dollar index, therefore I'm vis-a-vis, I have to be bearish on the euro since they're inversely correlated. So I'd be looking for a break below 106.60. I might decide to go short before that, but certainly on a break below 106.60, that's something that would bring me into a position in the euro on the short side. That's the one that I'm keeping the closest eye on right now.
Okay, we do have time. I have to read this. It's not really a question. It's more of a comment per se. It comes to us from Sneedless Gaming. Weston looks like he's live from prison. I think that's a brick wall comment. I think.
No, I'm in prison. Yeah. Nice. Yeah.
No, it's good to get the view from the inside. So with that, let's do final thoughts, key takeaways from both of you. Weston, first over to you. Final thoughts you'd like to leave our listeners and viewers with.
Final thought, big picture regarding this Bank Japan pick nominee. In the big picture, in the big grand scheme of things, it doesn't matter who it is. It doesn't matter what their intentions are. It doesn't matter what their history is. It doesn't matter what their policy preferences are. It doesn't even matter what their policy intentions are. Because the ghost of Kuroda is going to be haunting this regime for a very long time, and they do not have these buffet of options to choose from. Eventually, they're going to have to continue on with this irreversible path that Governor Kuroda has put the Bank of Japan and Japan in. And so any sort of move that you see that a departure, this huge departure from Kurodanomics, that's an opportunity timed well with someone like Dave is a far better trader than I am. If you time it well, you can trade it to revert back to the days of continued yield curve control, capping of the yield, or whatever it is, or continued easing and accommodation, even if it's by another name or label or whatever it is, in some form from Japan, because that's the only sort of option left, lest they like to blow up the entire world and their pension system and all that kind of stuff.
Dave, over to you. We'll let you close it out. Final thoughts, key takeaways you'd like to leave us with.
Well, I would just like to say to Weston, I think the analysis you did here today was fantastic. Gave me a couple things to think about, and given how you wrapped it up there, I think that's really quite good. And again, it's problematic across all central banks, but in particular for the BOJ. I think they've made a mess of things, but it's a conversation for a different day. The way I approach things, again, I'm not trying to go into tomorrow with any opinions on anything, but I'm happy to react to what happens. For me, it's always about the price levels. Does the trade make sense? Is there an asymmetric payoff? And I think the other thing is, you don't have to be in there every day doing things. You should be trading when something fits into your trading style. And I think the key thing, as always, is make sure you know what your trading style is, because if you don't know, you're going to be trying all sorts of different things, and you'll never get any traction going forward that way. So I know that's not necessarily trade-related information, but I'd be kind of being disingenuous if I said, hey, do X, Y, and Z if these numbers come out that way, because that's just way too tall of an order, at least for the time frame that I trade on.
Yeah, important context, and I think it's always so insightful and helpful to give a little bit of context on how you think about things more broadly. Dave, always a pleasure to have you on the show. By the way, I see Dynamo Trader has just asked this question. Is that a Canadian took on Ash's head? It is actually merino wool cap from New Hampshire, an American company called Minus 33, and they're the warmest merino wool hats known to humankind. I'm a huge fan. Guys, fantastic show, man. To get to hear someone talk about this from the perspective of a trader looking at technical levels, Weston on the ground in Tokyo, bringing us a little bit of context on how you see things more fundamentally, how you analyze what's happening as someone who knows a lot about Japan. Just a great conversation, man. I hope we can do this again soon.
Absolutely. Weston, thank you so much. I really enjoyed it. Good talking with you again. And Ash, as always, and the whole team at Real Vision, you guys always do a great job. Thank you so much.
Yeah, thanks, guys. Really a pleasure to have you both here. And thanks again for watching Real Vision Daily Briefing. See you tomorrow. We'll be back with Tony Greer. See you then. Have a great afternoon, everybody.